Bitcoin had its best January since 2013, and markets are responding positively to Jerome Powell's FOMC announcement. The cryptocurrency market cap has grown from $795 billion on January 1st to just over $1 trillion in about a month. And both majors and altcoins have seen considerable recoveries in the past 2 weeks. So what could all of this mean looking forward, and where can we begin looking for DeFi opportunities? As you've likely heard, Layer 2s have been gaining significant traction lately. So today, as part of our quest to bring you up to date on Layer 2 developments, we're diving into the biggest L2 player Arbitrum's DeFi ecosystem. A great place to start when evaluating opportunities is, of course, following the money. But before we get lost in Arbitrum's exciting DeFi ecosystem and break down each category for you, it's worth noting that there are plenty of DeFi opportunities that we'll be keeping an eye on in the coming weeks. So please hit the subscribe button now to stay informed and let us know in the comments which categories or protocols you want to learn more about. So without further ado, Arbitrum, the largest Layer 2 protocol by far. Where's the liquidity and how are investors using the protocol's offerings to make returns? Derivatives form the largest pools of liquidity in Arbitrum, and they account for about half of the ecosystem's TVL. GMX is a clear leader in this category with over $450 million of TVL in the Arbitrum chain alone. According to DeFi Llama, the average APY across the 4 liquidity pools being tracked is currently 15%. Decentralized exchanges on Arbitrum are in second place with 20% dominance, meaning that around a fifth of the total value locked on the largest Layer 2 chain is currently in DEXs. 3 of the largest and most popular exchanges are Uniswap v3, SushiSwap, and Curve. Uniswap v3 is the largest of the 3 exchanges and has a TVL of over $2.8 billion. The Uni token is up 20% in the past month and currently trading at 40% higher than the 52-week lows, although the Uni price is still far from its all-time high of over $40 back in May 2021. There's been considerable optimism around the future of Uniswap in recent weeks, particularly after a Uniswap community poll found that 80% of voters were in favor of deploying V3 on the Binance Smart Chain. The likelihood of broader adoption, more token holders, and the potential upwards pressure on the Uni price were deemed significant motivators for the vote's outcome. Beyond the 3 largest DEXs we just mentioned, there's also Arbitrum native decentralized exchanges worthy of consideration, such as Camelot DEX and Shell Protocol. Camelot prides itself on being a community-driven DEX, while Shell Protocol has positioned itself as a low-complexity protocol which allows users to save on gas fees. Derivatives and DEXs may well be the biggest parts of the Arbitrum ecosystem, but they aren't the only categories worthy of consideration. The third largest category by TVL is lending, and between Radiant, RVV3, DeForce, and some smaller lending protocols, this category accounts for around 8% of Arbitrum's TVL. DeFi sleuths like Adam Cochran have commented on the exciting future of DeFi lending thanks to protocols like Radiant, which take the existing money market model, build it cross-chain, and make it entirely community-operated. Aave is a fully decentralized community-governed protocol which allows token holders to supply, stake, borrow, and vote. There's over $6.9 billion of liquidity locked in Aave across 5 networks, and the protocol offers a bug bounty for any help in finding bugs or vulnerabilities. Now, Yield is a close fourth in this list with a similar TVL to lending protocols. The leading names in this category are TreasureDAO, Convex Finance, and Umami Finance. TreasureDAO is a decentralized gaming ecosystem, while Umami Finance has a zero-emissions tokenomics model where stakers earn 50% of all protocol rewards by staking or marinating Umami tokens. And as we mentioned in this video on the battle for roll-up dominance, there's serious competition in the Layer 2 space when it comes to helping Ethereum scale. Part of that process is helping users move their assets between chains. The cross-chain category is therefore the 5th largest in Arbitrum by TVL, and the category is dominated by 3 protocols. Synapse allows users to earn up to 106% yearly APY for staking LP tokens and 9.3% APY for providing liquidity in the Arbitrum ETH pool. But that's not all, because Arbitrum even has options exchanges, which might be of interest for those more familiar with traditional financial instruments. DEX is the largest decentralized options exchange on Arbitrum, allowing users to earn yield on staked tokens, liquidity farming, and trade options with weekly expirations as opposed to the traditional 1-month expiry period. For example, the DPX WETH liquidity farm currently offers 27.7% APR. And for anyone thinking there are far too many options to choose from, yield aggregators such as Beefy Finance can make the process easier by optimizing multi-chain yields and auto-compounding the returns to save you time and fees. And that brings us to the final word. Caution is critical when evaluating which project to invest in. And while we're not here to offer anyone financial advice, a word on due diligence. It's important to thoroughly research any investment opportunity and consider factors such as the project's development roadmap, the team, and the overall market conditions before making any decisions. The crypto market can be highly speculative and volatile, so it's crucial to only allocate what you can afford to lose. If you're feeling stuck on how to begin comparing options, here's a starting point by Edgy. As always, thank you for tuning into the Defiant, and we'll see you in tomorrow's weekly recap.